It's a historic week for gold as the yellow metal has breached all-time highs, past its 2011 highs, setting new records. Joining me today are two very special guests, both who have been very bullish on the yellow metal for quite a while, and both whose predictions have come true. Joining me today is Jim Rickards, best-selling author, and Peter Schiff, CEO of Euro Pacific Capital. Gentlemen, it's an honor to have both of you together at the same time. Welcome.
Thank you.
Let's start with you, Peter. You've called for gold to hit much higher levels for quite a while. Tell me about what your initial reaction was when you first saw that 1900, 1920 level this week.
Well, I'm surprised it's actually taken this long to get here, because the last time we were in this area, it was 2011. And a lot has happened in the last decade almost. We've certainly printed a lot of money. And I think the world should now be able to figure out what should have been obvious back then, but wasn't for whatever reason. And that's that the Fed has moved into a policy from which it can never extricate itself. When we went to zero, when we did QE, people initially thought it was temporary and that the Fed could normalize rates and shrink its balance sheet. And I said from the beginning that that was impossible. And I think the markets are now beginning to realize that I was right about that. And when they contemplate a future of endless money printing and 0% interest rates forever and multi-trillion-dollar deficits funded by the Fed's printing press, it's starting to sink in, and they're getting rid of their dollars and they're buying gold.
Jim, you as well, you've called for new highs for gold. Tell us about how the current price level fits with your macroeconomic thesis.
Well, it's a big increase in particularly a pretty short period of time. Peter's right, it's been a long haul from 2011. But the thing I would point out is that there are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really talking about when we say, gold is up, what we're talking about the dollar price of gold. And I view it as a cross exchange rate. People talk about the dollar, the euro dollar exchange rate. The euro is now $1.17. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So there's just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar. But the first great bull market was 1971 to 1980. Lasted 9 years, and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up at just a little under 700%. But in between, you had a bear market from 1980 to 1999. It's a long one, almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. And we had a second bear market starting in 2011. Now, I had a very interesting conversation with Jim Rogers. Jim is one of the great commodity traders, money managers of all times. And we were down in Dominican Republic at Casa de Campo. This is around 2014, but the bear market started in 2011, but it really fell off a cliff in 2013. So I said, Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just hit me right between the eyes, and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base, because you need a base. So you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit.
Peter, do you agree? Can we be seeing a 50% retracement before prices rally more?
A 50% retracement of what? What movie are you talking to? I think we've already seen the big retracement of that original bull market that Jim talked about, where gold went from under 300 to just over 1,900. I think we've now formed a very solid base really between about 1,200 and 1,500, which is where gold was trading for most of those years since it peaked. And now I think we've broken out of that range. I think we've taken out the highs. I think it's another leg of the bull market. I don't think there's going to be any significant pullbacks from here. I mean, there'll be pullbacks, but I don't think they're going to be very significant. I think if you're waiting for a big drop to buy gold, you're going to wait a long time. And when you finally get it, I think it's going to drop from a much higher price than it is if you just bought it right now.
Yeah, I agree with that. When I was talking about retracement, we had it. The retracement's over. I'm not forecasting a retracement. Quite the opposite. I think it goes a lot higher from here. My point was that we had the retracement between 2011 and 2015. That's done. Now it's just onward and upward.
Yeah, the thing about Jimmy Rogers, though, I ran into him at many conferences, and he was waiting for a retest. I mean, Jim was waiting for gold to go to 1,000, and then he was going to buy more. I kept saying, Jim, it doesn't make sense. It's too risky to wait for 1,000 because it may never come. And of course, it never came. And then there were a lot of people who were waiting, for 1,200 when it was at 1,500. I mean, the world is going to be full of people who are waiting to buy gold and who are broke because they didn't just bite the bullet and buy it.
So I've spoken to an economist recently who told me that if you look at the last time that the Fed expanded its balance sheet on a significant level during the last recession, what we saw was gold rising in tandem along with the expansion of the Fed balance sheet. In fact, during the years 2009 to 2011, that 3-year period, gold rose 200%. And so if we apply the same growth metric to today's situation where we also have the Fed expanding its balance sheet, what we're going to see is a $4,000 gold price target. Could this happen? Peter, let's start with you.
Well, remember, too, the only reason that gold stopped rising at 1,900 was because the world was convinced that the Fed could unwind the policy, that it could normalize rates, that it could shrink its balance sheet. Had the market not believed that, then gold would have kept rising. The way they were able to stop the price of gold from going up in 1980, that prior bull market, was because Paul Volcker did the right thing and let the market set interest rates, and rates went up to 20%, and that broke the back of that gold bull market. Well, what's going to stop gold this time? They can't let rates go up because we're too broke to afford it. They're not going to be able to bluff that they're going to raise rates in the future because no one's going to believe that. They're not going to be able to pretend they can shrink the balance sheet because if they couldn't shrink it when it was $4.5 trillion, how are they going to shrink it when it's 10 trillion or 20 trillion? Who knows where it's going? So I don't really see how there's any way that they can stop the dollar from collapsing. In fact, in 1971, that's when we went off the gold standard. And the dollar got marked down sharply in the decade ahead. It lost about 2/3 of its value against the euro. I mean, not the euro, the Deutschmark, the Swiss franc, the Japanese yen, and it did even worse against gold. But I think now it's not just the dollar severing its ties to gold. It's going to be the world severing its ties to the dollar. The world is going to go off the dollar standard and back on the gold standard. And I think that this is going to be a more precipitous drop in the dollar's value than it was in the 70s. And so we could see something equally as impressive in the price of gold.
We're going to talk about the dollar in just a minute, but Jim, let's go back to the first question here. Where do you think gold is headed from here? Are we overheated? Do you see more room to climb?
Well, we're not overheated at all. I've got gold at, I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, and 7,000 first. So there's plenty of room to run, plenty of room for profits. But, when I say things like that, David, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air and, for publicity because I could care less. But if you just took the average, and there are a couple ways to think about it. Just take the average of the two prior bull markets I mentioned. So 71 to 80, 9 years, 2,200%. 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025, and at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. But there are other ways to think about it. Now, going to Peter's point, I don't know if there'll be a gold standard or not, but I do know that gold will move. The price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less. You come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years.
Of course,
that's what
Jim,
I expect.
It's a moving target because between now and then, there's a lot of money that's going to be printed. So who knows where the price of gold has to end up by the time we finish all the money printing.
That is correct. It is a moving target. The numbers I gave you are based on current levels, but Peter's exactly right. You keep printing money, you need a higher price if you want to reference gold and not cause deflation, which they don't. You're going to need a progressively higher price of gold. One thing people forget, David, is that they look at the dollar price in absolute dollars. So it went up $100 an ounce, or I expect before long it'll go up $1,000 an ounce a week. But each dollar increase is a smaller percentage increase. So people look at the dollar. Yeah, it's real money. It's nice to make the money. But, if you go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. I mean, you can do that in a week. So my point is, it's still $1,000 an ounce, good for the holders, but the percentage increase gets smaller and smaller as the absolute dollar amount gets larger and larger. So $15,000 sounds like a big number from today's perspective, but as you go to 10, 11, 12, it gets to be a progressively smaller percentage increase, and therefore more likely. You need to see it logarithmically to see it on a more a less hyperbolic curve. So logarithmically is the right way to think about it, but in dollar terms, the percentage increase gets to be pretty small at those levels.
Yeah. Well, another way to look at it, Jim, is just look at the price of gold in relation to the Dow Jones, because you have historical reference points where twice in the prior century at significant bear market lows, the Dow traded down to a single ounce of gold. 1932, the Dow Jones was roughly equal to an ounce of gold. And in 1980, the Dow was roughly equal to an ounce of gold. So if you look at where the Dow is now, around 26,000, and figure, well, where would the price of gold have to be equal to the Dow? Well, at the current price, 26,000. But maybe if we get a big bear market, those two could meet around 15,000. And so you'd have the Dow Jones at 15,000, which is significantly below the current level. And you'd have gold much higher. But of course, if they create massive inflation to prevent that stock market bubble from deflating, it's possible that an ounce of gold and the Dow could meet at 50,000. I mean, it does, the key is that they're the same price at some point, not necessarily what that price is, but that they're the same.
That's right. And David, when I say $15,000 an ounce, I don't think I'm stretching. I mean, Peter's right. Could it be 25,000, 40,000? I mean, just take my monetary equivalent. If you use M2, and by the way, when I used M1 and did that math, that's with 40% backing, because historically 40% has been a high level of backing. If you take M2 at 100% backing, you get to 50,000 an ounce in a heartbeat. So Peter's right. My numbers, I think, are conservative. They could be much higher.
Let's turn to risk assets now. I want to talk about modern monetary theory, which is a relatively new economic theory that contradicts a lot of classical economic principles. It's being picked up by a few notable investors and politicians right now. Ray Dalio, for example, has written about it recently. And for the viewers, MMT basically states that countries can finance their operations by continuously printing money without really the fear of inflation. So my question to you, and I'll start with you, Peter, is does this theory have any validity? Because a lot of equities bulls are citing MMT as a reason to maintain their long positions in the markets.
Well, first of all, I don't think there's anything new about it, and I don't even think it's a theory because we already know it doesn't work. So there's nothing theoretical about it. I mean, you've had plenty of examples in history where currencies have been destroyed based on what they now call modern monetary theory. Look, the whole idea that you could print all this money and not have inflation, the printing money is inflation. So by definition, you're creating inflation, so you have it. Now, obviously, there are situations where you can create inflation and it may manifest itself in rising asset prices before it ultimately moves into rising goods prices. And if you have a very productive economy that is generating more output of goods, then maybe you can create a lot of inflation without the price of goods going up because you're merely preventing the price of goods from falling, which would have otherwise benefited the citizens because they would have been able to buy more for less. But at the end of the day, what they're advocating is not a free lunch, right? You can't have government for free simply because you print the money to pay for it. In fact, the most expensive way to finance government is through inflation, is through printing money. It's much better to do it through legitimate taxation. But of course, the public will resist taxes, especially when they're already broke, like most Americans are. But this is a panacea for government. They can pretend that they can have this laundry list of socialist programs. I mean, look at what we're doing now. All the bailouts, all the enhanced unemployment benefits, the PPP, right? Everybody is getting bailed out and nobody is getting a bill. Nobody's taxes are being raised. Everything is being paid for by the Fed because we think it's all free because everybody believes in MMT, whether they want to acknowledge it or not. But we're about to see that it's going to be a complete disaster because the dollar is going to collapse. And then, of course, what the MMTers don't get is, well, what do you do? What happens when inflation goes out of control? What happens when prices really start to go up? How do you stop it? Once you've let that genie out of the bottle, how do you put it back in? It's impossible.
Jim, what do you think? I mean, quantitative easing has been one of the driving factors behind the equities bull rally. Can you see this stopping anytime soon?
No, I mean, Peter's right. The Fed dug a hole and they can't get out of it. And I said all along, but certainly, 2014, 2015, et cetera, as they did the taper and then they did the liftoff and then they raised rates and all that. I said the Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates. Normalization meaning they'd love to get rates to around 3.5%, 4%. And they'd love to get the balance sheet down to maybe $2 trillion from a level of $4.5 trillion where it was in 2014 and a level of interest rates of 0. So they had to get rates up, balance sheet down. Why? So they could prepare for the next recession. They weren't forecasting a recession, but they knew one would come eventually. And it takes about 4 to 5 percentage points, 400, let's say, basis points of rate cuts to get the U.S. out of a recession. How do you cut interest rates 4% if you're at 1? Well, the answer is you can't. And that's why they came up with quantitative easing. So the effort was get to 4% rates, $2 trillion balance sheet, and you're ready for the next recession. That's what they were doing. That's what made forecasting the Fed child's play. It was very easy. But I also said they won't be able to do it. They will not be able to prepare for the next recession without causing the recession that they're trying to prepare for. And that's exactly what happened in the fourth quarter of 2018. Between October 1st and December 24th, 2018, the stock market dropped 19%. It was 1 point away from a bear market at that stage. And then you had the Christmas Eve massacre. And that's when Jay Powell threw in the towel. He got religion. He said, okay, first he said, we're not going to raise rates anymore. Then he said, we're on pause. Then he said, we're actually going to cut rates. And then 9 months later, he said, we're going to end quantitative tightening, which was reducing the balance, the money supply. And then in September 2019, they started QE4, which is that was before before the recession, before the depression, before the pandemic. They were already in QE4 and cutting rates again. So they can't get out of it. Now it's worse because they're back to 0 and the balance sheet's up to $7 trillion at this point. So they prove that the failures manifest. They prove that they can't get out of it. And what can they do? By the way, on modern monetary theory, I mean, you're right. Peter's right. There's nothing new about it. This comes in a book called The State Theory of Money by Georg Knapp, which was published, I think, in 1921. Might be off by a year, but 2021, somewhere in there. But you say, what's the secret behind money? I think it's garbage, by the way. But you say, what's the secret behind it? Well, the secret behind it is if you can issue debt and collect taxes in the money that you print, you can force people to accept the money because they need the money to pay their taxes. And if they don't pay the taxes, they end up in jail. Now you can get extensions or do whatever, but at the end of the day, if you manifestly refuse to pay your taxes, they will come and put you in jail. And the point is, it relies on state power. It's really a neo-fascist concept. It relies on coercion, the point of a gun, jails, and state power to enforce the confidence in money. Now and they say that. I mean, I've read Stephanie Kelton. She's the bright light. I mean, this goes back a long way, but I've met her, read her books and her book, I should say, and her articles. But they're very explicit about that. Now, I think that's completely wrong because there's so many workarounds and so many ways to get out from under that kind of state power. But they do rely on state power at the end of the day. So that's why it has this neo-fascist element. And beyond that, Stephanie Kelton, who was a professor at State University of New York, was also the chief economic advisor to the Bernie Sanders campaign. Now, Sanders' campaign is over, but Biden, to get the Sanders vote, is basically endorsing the Sanders platform. He has to get the Bernie bros to vote for him in November. If he wins, you're going to see Stephanie Kelton at the Treasury or maybe on the Board of Governors, sitting 5 feet away from Judy Shelton. That'll be interesting. Yes. But this is
that's the only way that they can try to pay for everything they're promising the voters in exchange for their votes. Medicare for all, free college, reparations for slavery. I mean, where's the money going to come from? I mean, we're broke. We're already hopelessly in debt. The middle class can't pay higher taxes. If they raise taxes on the rich, well, they won't collect very much. There won't be much wealth left after they finish taxing it. So the only source of the money is the Fed. So obviously they're going to embrace this theory because it's so self-serving. And, they've been lulled into a false sense of complacency because it seemed that we've been able to get away with it. We have printed all of this money since the '08 financial crisis, and everybody thinks it hasn't caused a problem. Everybody says, look, see, there's no inflation. We printed all this money. The balance sheet has exploded. And look, prices haven't gone up. So they now have this false sense of security that there's no limit to how much they can print. Well, what's basically been keeping us from having to deal with those consequences has been that reserve currency status, has been the willingness of the rest of the world to hold on to that paper in the form of treasury bonds or corporate bonds or mortgage-backed securities or even U.S. stocks, right? So as long as they're willing to park the money in financial assets, then it doesn't bid up consumer prices. But once they lose confidence in the dollar, then they lose confidence in all dollar-denominated assets, and now they want out. And now all that money is going to come rushing back to the U.S., bidding up the price of whatever's not nailed down.
All right, we have a few minutes left, so I have one last question for the both of you. What are the major risks that you're looking out for today? We're already living through the worst pandemic in recent history. We're seeing a recession that some analysts would say is even worse than the Great Depression of the 1930s. And in response, we're seeing monetary stimulus on a historic level. Jim, let's start with you. How could things possibly get worse from here?
Yeah, well, first of all, I encourage everyone to stop using the word monetary stimulus. There is no monetary stimulus. There is money printing. Yes, there is money printing and debt monetization, but it has no stimulative effect. You don't get inflation from printing money. You get it from velocity, which is psychological, which the Fed doesn't understand. But the biggest threat is deflation.
Peter, you've argued that we could see inflation as a tax. So how would you respond to that?
Well, first of all, the only thing you're going to see deflation measured in is gold. But in terms of fiat currency, prices are going to go up dramatically because they will continue to print the dollar until it no longer has value. That's the only thing that's going to stop it. But look, what we've seen so far, even with the civil unrest and the riots and the looting, this is just a small dress rehearsal for what's coming. Because when the dollar crashes, and prices skyrocket, right? These stimulus checks, or whatever welfare benefits the government wants to dispense, they're not going to be worth very much. I mean, because you're not going to be able to buy anything. And I think the government is going to respond to the surge in consumer prices with price controls, kind of the way we did in the 1970s. But prices are going to be rising much faster now than they did back then. But I think there's going to be controls on all sorts of consumer goods, and that means shortages. That means long lines. And I think there's going to be power rationing. And so I think you're going to see a real blow up, particularly in the cities. There's going to be a lot of crime, a lot of violence associated with widespread shortages and a lack of food and power outages. So things are going to get pretty bad as we go through a monetary crisis. It's not, this is not just a financial crisis. This is a U.S. dollar crisis and a sovereign debt crisis. That's a whole nother ballgame.
Jim, I'll let you respond and close the argument.
Yeah, well, I agree with Peter that the Fed wants inflation, but they don't know how to get it. And they haven't for the last 12 years.
Well, that's the one thing they do know how to do. They can cause inflation. That's all they can do. They can print money.
No, they can't. They can't, Peter. They printed $7 trillion in 12 years, and we got no inflation. Assets, yes, but I'm talking about.
I mean, prices are higher than they were 7 years ago, consumer prices, but we inflated a stock market bubble. We inflated a real estate bubble. We inflated a bond market bubble. I mean, asset prices went way up. We distorted the economy based on all that inflation. And look, consumer prices have risen, right? I mean, I don't care the way the government wants to keep track of them with their, with the CPI. The CPI is not an accurate reflection of what's actually happening with consumer prices.
It's pretty good. Look, if you want to count assets, you're right, but you're changing it's moving the goalpost. You're changing the definition.
No.
If you count assets, yes, but I count consumer prices or PCE core deflator, because that's if you want to predict Fed policy, that's what they look at. So you need to consider.
I don't care what the Fed looks at. I care about reality. And prices are going up, but that's not inflation. Because if the Fed didn't create all this inflation, maybe those prices would have really come down. Maybe consumers would have gotten the benefit of a lower cost of living. But the Fed stole that benefit away from them by creating inflation. But look, all of this inflation is going to come home to roost. All of a sudden, we're going to catch up and we're going to see dramatic increases in consumer prices. And then when you go back over the entire period, you can say, oh, look, prices are up 10% a year or whatever they're going to be, because all of a sudden they're going to shoot way up. And it's not going to matter that they were benign for a while when all of a sudden they skyrocket and catch up to where they should have been. But the cause was all the inflation the Federal Reserve has been creating the entire time.
Well, I agree that if the Fed didn't do what they did, we would have had more deflation. And in a way, they were just fighting it to a standstill. But we haven't had inflation for 12 years. Asset prices, yes, but that's not the definition of inflation.
The definition of inflation is an expansion of the supply of money. And that's what we've had in spades. This is the greatest inflation that the world has ever experienced.
You can make up your own definitions, Peter. The definition of inflation is higher prices.
Jim, I'm not making up the definition. It's people today. You go back and get a Webster dictionary from 100 years ago, and you read what inflation is, and it'll say inflation is an expansion of the money supply of money and credit. Rising prices are an effect of inflation, right? Prices don't inflate. Prices go up and they go down. Money supply inflates. Inflate is to expand, right? You don't expand prices. What is being expanded is the supply of money. That's inflation. Inflation is an expansion of the money supply. Deflation is a contraction of the money supply. The effects of inflation and deflation are on prices. When you have inflation and you're inflating the money supply, prices will go up. And when you're deflating it, prices will go down. But sometimes you can inflate the money supply and prices don't go up because the inflation is preventing prices from going down. But don't confuse changes in prices with changes in money supply. Money supply is inflation. Prices are just prices.
The problem, Peter, look, we're talking past each other because we have two different definitions. If you say that prices are flat, but that's inflation, fine. That's not how any central banker in the world or any economist thinks about it.
The central bankers want to pretend that inflation has to do with prices because they don't want to be blamed for it. When you accept the real definition of inflation, which is an expansion of the money supply, then you know who causes it. It's government. It's central banks that cause inflation. But governments want to blame inflation on the private sector. That's why they want to redefine it as prices. And you're playing into their propaganda by trying to perpetuate the idea that inflation is caused by greedy businessmen raising their prices or labor unions or speculators.
Now you're way over the line.
Well, you're saying inflation is prices going up.
You're putting words in my mouth that I never said. I said that inflation is measured by prices. That's just how you do it. If you have a different definition, that's fine.
No, inflation is measured by the money supply.
Thank you very much, Jim Rickards and Peter Schiff, for being on the show. It's a tremendous honor once again to have both of you. So I do appreciate it.